Good morning. Let's study TZOO. Ticker symbol is TZOO. We'll start by technical analysis. This is the all history chart. The stock had this huge bull run here in mid 2004. It was really a market darling, and then it collapsed to below $20. But now it is bullish again, here above the 200 days moving average and the 50 days providing support here. Let's check the short term chart. Yes, we also have this ascending trend line and this ascending triangle breakout yesterday. We also have this resistance here at 40.1, but the chart tells me the stock will break out above this short-term resistance level. So technical analysis says TZOO goes north. Let's check the fundamentals. Fundamental analysis. Well, this is the share count since 99, and you can see this company has been buying back shares quite aggressively indeed. Just 15.3 million shares outstanding now, and the market cap is $607 million. The share count compound annual growth rate is minus 5.8%, so I really like this situation with the base year of 2003 when the share count was 19.4 million and now just 15.25 million again. Market cap compound annual growth rate since 2003, 37.9%. Let's move on to study the balance sheet, long-term debt and current ratio. There's no long-term debt, it never was, and there never was, and the current ratio is quite high at 5.4, which means the current assets are 5.4 times larger than current liabilities, which is very healthy. And from these current assets, 77% is cash and marketable securities, so very strong balance sheet. Moving on. As for revenues and gross margin, well, revenues grew every year since 1999. You can see 0.95 million in 99, 3.95 million in 2000, 6.15 million in 2001, about 10 million in 02, 18 million in 03, 34 million in 04, 51 million in 05, 69, about 70 million in 2006, and expected for 07 and 82 million, and for 08 94 million. But this is a bit of a slower growth going forward. I guess there will be slower growth, but I don't know if it will be this slow, Revenue compound annual growth rate since 99, 84.7% for TZOO. And for the industry average, the growth from the 2005 levels to 2006 was 37.8%. Gross margin is 99% for TZOO and 65% for the industry average. Price to sales ratio 8.73 for TZOO and 3.44 for the industry average. By the way, let me tell you what is the industry. TZOO's industry is internet information providers. Okay, let's move on to check the profitability. TZOO earnings per share and net margin. Well, the company, this is interesting. The company was profitable right from the start with just 1.05% net profit margin and 1 cent of earnings per share. But and earnings have grew, I believe, every year since 99 to $1.01 in 2006. Analysts are expecting just $1.26 for 07 and $1.49 for 08, but I believe they're being too conservative here, because you see net profit margin has been growing as revenues grow from 8.6% in 2002 to 11.4% in 2003, 17.9% in 04, and they declined here a bit to 15.7%, but in 06, 24.16%. Well, given these earnings per share projections, analysts are expecting 23% net profit margin for 07 and 24% for 08. But if this margin expansion continues, it might well be 30% or more instead of this 23-24%. I believe this may very well happen. Earnings per share compound annual growth rate since 2002, 124% for TZOO, but it's from a very small base of just 4 cents. And if I did it from 2000, it would be much higher. Net profit margin 24% in 2006, and price to earnings ratio, considering this 2007 projection of $1.26 per share, is 31.6 for TZOO and 35.3 for the industry average. Given all this information, I build my valuation model for the next 3 years. We have these yellow lines are known facts, and these orange lines are estimated, are calculated automatically by the model, so I only have to estimate these white lines. Dilution factor, I put here 0.98. It means I expect the company to buy back 2% of its shares every year for the next 3 years. They've been buying back more than that, about 6%, but to be more conservative, I put here just 2%, because we never know. Revenue compound annual growth rate, I put here 30%. We know it has been a lot higher than that in the past. Let me check here. No, not this graph, but this one. It has been 84.7%, but due to the law of large numbers, revenues are higher now. It will be more difficult to grow at very high percentage rates, but I believe 30% looks reasonable, especially considering the company's expansion to Europe now. And this final net profit margin, as we talked about it earlier, I consider it 30% going forward. I expect net profit margin to continue to expand as revenues grow. And earnings per share multiple estimate, it is the same as the industry average, 35.31. And this gives me a final estimated share price in 2009 of $112.74, and a share price compound annual growth rate for the next 3 years of 41.5%, which I consider quite attractive. Anything above 16% is good for me. And the optimal selling price today, considering all these, would be $72.22. This is the price where the share price compound annual growth rate would go from above 16% to below that. So that's my optimal selling price. I wouldn't want the stock anymore at this price with the current fundamental information. So I consider it attractive, and give it on a 1 to 10 scale 8 rating. Thank you. Bye.